This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're going to go through and look at our analysis and interpretation. And the first bit that we're going to go through and look at is looking at performance. So performance is the same as profitability. And essentially, we're looking there at our statement of profit or loss. And what we want to do is when we look at our statement of profit or loss, we want to be able to look at how the company has performed year on year. So has it become more profitable? Has it become less profitable? Has it turned a profit into a loss? Or has it even turned a loss into a profit? Okay. And what we're going to try and do is we're trying to go and help our analysis by looking at the overall picture in terms of how we have changed our levels of profitability, but supporting that with a bit of ratio analysis. Okay. So the first ratios that we're going to go through and look at are looking at the margins. I think all of these three here will be familiar to you, so it shouldn't cause you any great deal of difficulty within the exam. But nonetheless, it's worthwhile recapping them and make sure that you are happy with them, isn't it? So what you've got there, what does a margin tell you? Well, it's a really useful figure, isn't it? Because it looks at the profit that you generate per $1 of sales. So if you have a 50% gross profit margin, then that means for every $1 of sales, you have made a 50-cent profit. And what that then allows you to do is it allows you to look at the performance year on year and company versus company, because it takes away the size of the profit. Just because one company has made more profit one year than the next, the actual margin that it makes on that profit may actually be that little bit less. So what we go through and do is we take a profit figure, don't we, and divide it by your revenue or your sales. So the first one that you've got there, one of the most common, is your gross margin or your gross profit margin. Really simple, nice and easy to calculate. You take your gross profit and divide it by your revenue, don't we? Remember, it's a percentage, so you need to multiply it by 100%, don't we? Gross profit, probably going to be given to you within the question. If it isn't, it's your revenue less your cost of sales, isn't it? And that's it. We'll look at why it may move in a moment. Other one that you've got is your operating profit margin. So that just takes you from your gross profit down a little bit, doesn't it, to your operating profit. So looks at your profit after all of your expenses, so admin and distribution, doesn't it? Takes your operating profit, so your profits before interest and tax, and divides that there by your revenue and multiplies it by 100%. Ideally, what you should see is that if you have an increase in your gross profit margin, ideally you should see an increase in your operating profit margin as well. If you don't, that tends to indicate that you are not controlling your costs in the business as well as you have done in previous years. The final margin that you've got is like the one that's really sat down at the bottom of your statement of profit or loss, isn't it? And that's your net profit margin or your profit for the year margin, which takes your profit for the year and divides it by your revenue before then multiplying it by 100%. You may be asked to calculate your net profit for the year margin, but it's not all that useful as a ratio. Ultimately, there are better ratios to go through and consider, and I'd always prefer to think about gross margin and operating profit margin before I then even contemplate your net profit margin. The reasons why is when you look at your difference between your operating profit and your net profit, the items that go through there are not necessarily within your control, are they? You've got interest, which is a fixed level of payment, so there's not a lot you can do about that. And likewise, you've then got your tax expense, haven't we? And again, our tax expense, yes, we can get tax advice upon how to try and minimize our tax bill, but at the end of the day, there's not a huge amount that you can do with regards to adjusting your tax expenses, though. Okay, that the rates are set by the local government authority. So I tend not to worry too much about your net profit margin, but do have an awareness of its existence in case you are asked to calculate it. Okay. If we just go through and look at the first two in isolation, and look at reasons why that they could potentially go through there and move. If we look at your gross profit margin, all we're going to do is we're just going to make up some numbers, okay, make up some percentages. I'm not worried about the calculation just yet. Okay, we'll see that later in some of the examples. So let's just say there that in the current year, you've worked out your gross profit margin to be 40%. Okay, so you're making 40 cents for every $1 of sale. In the prior year, let's just say it was 30%. So you're making the 30 cents on every $1 of sales in the previous year. So has your performance got better or worse? Yeah, it's got better, hasn't it? We're generating more per dollar of sale than what we were last year. Okay, it's not to say that we're more profitable. Okay, the gross profit margin this year could possibly be less than last year. It all depends upon the volume of sales that we make, but we are performing better on a like for like basis, aren't we? Okay, so the reasons why your gross profit margin may have increased is we could have a decrease in the cost per unit, not in your overall costs. And there could be an increase in the selling price per unit. Whatever you do, do not think that if you have an increase in your sales, you have an increase in your margin. That's not the case, is it? Yeah, we need to look at it on a per unit basis. Yeah, so just be very, very, very careful. So what you've got there is if you look at a reduction in your cost per unit, reasons why, maybe you bought some goods in bulk. If you've bought goods in bulk, you have possibly got a quantity discount, which has reduced your cost per unit, hasn't it? Could be that we've found a new supplier. If we have a new supplier, the reason why we've gone to that new supplier is because they've offered us a cheaper product. If therefore it's a cheaper product, it reduces the cost per unit. The only thing I would just bear in mind to balance that up with is that it's great to buy products cheaper, isn't it? But you do then just need to think about your quality issues. If you buy cheaper products, there's always that risk, isn't there, that you're buying products of a less quality. Okay, and that could then have a reputational impact when you sell those goods, and those goods are then faulty. But that's just something bearing in mind to think about. Likewise, the reason why the cost per unit could have gone down is maybe you have got bigger and bigger as an entity and grown. The bigger you grow, the more you have purchasing power. And you may have got to a position now where you are so large that essentially you start to dictate the pricing terms to your suppliers. It tends to happen quite a lot in the supermarket industry because your large supermarkets have much more power over your small little farms in the countryside, and they then tend to dictate the price of eggs and the price of milk. Okay, uh, we can worry about the fairness and the ethics of it elsewhere, but that is what happens, isn't it? Okay, the large supermarkets dictate the prices and also dictate when they pay their smaller farmer suppliers. Other reasons why the cost per unit may have gone down, it could be a learning effect. Whatever products it has, maybe you've automated the production line, you've got some other technology changes which has reduced in efficiency savings, and those efficiency savings in production have reduced your cost per unit. Okay, any of those you need to keep an eye out, don't you, within any objective test question. These questions I think are going to be quite tricky because they're likely to be those select all questions and get you to select all out of 5 or 6 possible options the reasons why a ratio may have potentially moved. So it really going to encourage you to try and think around the issue at hand and the specifics given in that small little bit of information in the question. Your selling price per unit may have gone up. Why? Could be that there's been an increase in demand. If there's an increase in demand, it's over to your business then, isn't it, to try and take advantage of that increased demand. And the one way in which you can do that is to try and increase the selling price per unit. If your product is popular, push up the price. Okay, if you think about Apple, there's always a big increase in demand, isn't there, for that product, which is why you pay a really high premium for all the various products that it begins to launch year in, year out. If we also go through there and think maybe there's a shortage of supply, then you can push up the selling price per unit, can't we? If you think of petrol that goes into powering your cars, if there is a shortage of supply of the petrol, so oil from the Gulf has been restricted, then maybe the shortage of supply will allow you to go through there and put your price up. Okay, yeah, taking advantage of the situation that you find yourself in. It could be that you've decided to change the products that you sell. So maybe now you're selling a new higher margin product. Maybe that product isn't just a product that can be pieced together by people when they get at home. So IKEA, a lot of the things that you buy from IKEA, the Swedish superstore, it is flat pack furniture, isn't it? You take that flat pack furniture home, you try and put it together. You don't need anybody else to do it. It's just not specific to where your room is and how your bedroom or kitchen fits together. You need to try and fit it in yourself, don't you? However, let's just say IKEA decided to offer a fitting service and decided to offer a tailor-made bespoke kitchen or tailor-made bespoke beds or bedrooms, I should say, then that will increase the selling price per unit, okay? Because it will be therefore then a higher margin product and push up your margins, won't it? Okay, there we go. If we move on and start to look at your operating profit margin, the key thing that you should see with your operating profit margin is that, as we said earlier, if we have an increase in your gross margin in 1 year, you should also then see a similar increase in your operating margin in the same year. If you don't, it's potentially there because you are not controlling your costs. So if we continue with our illustration from before, we saw that there was an increase in your gross margin, didn't we? Well, let's just twist it. My operating margin, let's just say my operating margin has gone to 20% this year. And last year it was much higher at 25%. So we have an increase in our gross margin, but a decrease in our operating profit margin. So we're not controlling our costs as well as what we did last year. So why may that be? Let's just throw in some examples. Cost, there could be anything that happens. These are just a select few. Okay, you need to keep working the questions. Use your business experience that you have to help you through it. So could be you've got increased maintenance costs. You have yourself some old assets. If you have old assets, they start to break down. They need repair. You need to maintain them. If you have that, then you need to increase the cost, don't we? Increase the cost, reduce your operating margin. Could be maybe you've moved to some newer premises. You've got a new head office. You've got a new factory, and therefore that has got extra increased rent. Could be that there is therefore maybe you're not leasing it, but you own it. So therefore there is increased depreciation. Yeah, whether it's increased rent or increased depreciation, that is going to increase your costs and therefore reduce that operating margin. Could be you've launched a new product. If you launch a new product, what happens when you launch a new product? To get that product to market, what do you have to do? Yeah, you need advertising, you need marketing. Whenever Apple or Microsoft launch a new product, there's posters, there's billboards, there's television adverts everywhere. It's costly, isn't it? It's not cheap to do. So yeah, it increases the sales, but it also increases the costs, and maybe the costs are increased at a much higher rate. So therefore that reduces your operating margin. Could be there's an impairment. In recent history, we've seen plenty of, if you like, recessions, haven't we? And that therefore is an impairment indicator, and therefore that might reduce the value of the assets within your financial statements. If you reduce the value of the asset, you have an impairment, and that impairment is likely to be taken to profit or loss. If it's taken to profit or loss, it reduces your profits, yep, and it reduces your margin. Okay. Other one that you've got, going back into what we saw earlier on within the course, we looked at provisions, didn't we? Maybe there has been a recession, you have an impairment, and what you're trying to do is to repair the business by restructuring it, playing around with the management structure, streamlining management, maybe making people redundant. And if that's the case and you have the obligation at the end of the year, then there will be potentially a restructuring provision. And if that's the case, sets up a liability on the statement of financial position, but also has an expense in profit or loss, doesn't it? And if that's the case, it reduces profitability and can reduce your margins, can't it? Last one, I suppose, time to get into other bits you've seen from F1 is looking at research. Maybe you have carried out lots and lots and lots of research in the year on a new product. You haven't yet met the criteria to develop that research and convert it into technological know-how. So there is a lot more expenditure this year than what there was maybe in previous years. If that's the case, again, increased expense, reduced profitability, and reduced margins. Okay, there we go. So that's looking at the gross margin. That's looking at the operating profit margin. As I said, I'm not too worried about your net profit margin because that starts looking at things being impacted by changes in interest and changes in tax, neither of which we're too worried about it at this point in time. If we move on and just look at two newer ratios, if you so wish, that you may not have seen previously, we have what's first of all referred to as asset turnover. And that's looking at your efficiency, how well we go through and use our assets to generate our revenue. So by definition, that allows the users of the accounts to see how well the business is using its assets to generate our revenue. Because we would like to generate lots and lots and lots of revenue from a pretty small asset base. You know, the smaller the asset base and the larger the revenue, the better that business is performing, isn't it? Okay. So what you've got there is, first of all, it's based on a number of times. It's not a percentage or X to 1. It's looking at efficiency and a number of times that we can take our capital employed and convert that into revenue. And then the second thing is, the higher the ratio, the better it is. Okay. So your revenue is the top line figure from your statement of profit or loss. Your capital employed is something new. You know, capital employed is what you use within the business, isn't it? That those net assets. So what you've got there is, that's looking at your non-current assets, it's looking at your current assets and your current liabilities. But it's easier from a ratio perspective to not take all your non-current assets and add your current assets and deduct your current liabilities. It's easier to use the accounting equation, because what we can do there is that non-current asset plus current asset plus current liability is going to be equal to your equity plus your net debt. Okay, so you can take the equity figure straight from the statement of financial position, which essentially is share capital, share premium, retained earnings, revaluation reserves, and any other reserves that there may be attributable to the parent. And then what you can do there is you can add on that interest bearing debt. So things such as debentures or loan stock, maybe also some finance leases that you could add on there. Anything that is interest bearing, even an overdraft, you will put there within your net debt figure. Do just be aware, if you want to be really technically correct, if you're looking at your net debt, that takes your debt less any cash within the business. Because if you've got cash, then that cash should be doing something. Well, if it's there, it isn't doing something, and it's not generating revenue, is it? So therefore, we're going to remove that from our debt figure to work out our net debt figure. Okay, so any interest-bearing debt less a cash balance. But we'll see that in one of the questions a little bit later on. Just wanted to bring it in now so that you're familiar with it. The last little bit that we've got to go through and look at on our performance or profitability side of the analysis is looking at your return on capital employed, or ROCE for short. Okay. What is it? Well, it's a brilliant overall performance indicator. It's one of the key headline figures. Forget your margins, forget your asset turnover. This is one that investors really do go through and look at, because what it does is it looks at whether a business has performed better or worse than in the prior year. Because again, you think about your headline figures, think about your profitability, your profit for the year, or operating profit, or gross profit, whichever one it is. Here we'll see that we focus on operating profit. Just because you've made a bigger operating profit in one year compared to the previous year doesn't necessarily mean that you have performed better. It looks like you have on an absolute basis, but what about on a relative basis? Have we performed relatively well this year compared to last year? And what we do is we take our return and divide it by the capital employed to go through there and think about it on a relative basis. Are the profits that we're making this year better based upon the capital at our disposal that we have used to help generate those profits? So it's a brilliant performance indicator. We measure it as a percentage, and not only does it allow us to see if we as a company perform better or worse, what I also like it to do or show us is that it gives you a really good comparison between entities. So you could have two entities in the same industry, but one of those businesses could be absolutely massive. It makes huge amounts of profit. So think about one of your really large supermarket businesses, one of the top of the chain. They were massive profits, but their massive profits will be different to the small profits compared to another supermarket at the bottom of the supermarket chain. You might think, well, right, that company that's got all the profits is doing much better than the company that's got the much lower level of profits. Might not be the case, because we want to look at the capital that you employ to generate those profits. And what it could be is that because we've gone through there and made a like for like comparison by making things relative as opposed to absolute, then what we can do there is we can see whether or not that bigger supermarket has performed better than the smaller supermarket. And in a lot of the cases, you'll find that the smaller supermarket with smaller profits has actually performed better relatively than the larger supermarket. So the ratio, what's it all about? You take your profit before interest and tax, so your operating profit, again, hotel, motel, doesn't matter, does it? It's exactly the same. And you divide it by your capital employed, your equity plus your net debt. Again, don't forget to go through there, multiply it by 100% to go through there and get it as a percentage. Okay. In terms of calculations, I suppose you could be asked for any of those ratios. My preference, I suppose, given that you've seen a lot of the margins before, is that you're likely to see more return on capital employed or asset turnover calculations within the exam style questions. But when it comes to the analysis, you could be asked for anything with regards to the analysis. So work it through, make sure that you're happy with the calculations, learn the ratios, and then practice the questions to apply those ratios. And just be careful with the actual analysis bit. I think we've said already that that could be a little bit tricky. So practice the questions to build up your knowledge as well as your own practical experience as to why these ratios may or may not have moved. Other than that, I'll see you in the next session when we begin to go through there and look at some of the position ratios.